Hi, it's Dre Griggs with Obsidian Wisdom. Today we discuss the impact of inflation on your retirement savings. Inflation is that sneaky thief in the night. It's taking away the value of your hard-earned money over time. And we just went through a 40-year high of inflation, so you're already well aware that if you are retired, you lose your ability to adjust a lot of your lifestyle with inflation. The three key areas where inflation tends to hit the hardest is number one, our healthcare, because for most people, healthcare actually outpaces the average 3% inflation. Now, if you're younger and planning to go to college or you wanted to help your children go to college, that's another key area where education outpaces inflation. Education and healthcare tend to go up higher than 5% each year, while inflation is only 2 to 3%. The second way that inflation is the hardest is our everyday life expenses. And I'm going to share with you a few charts that shows just some average cost of goods and how they've gone up over time, and how sometimes their price outpaces inflation, and how other times their price actually is slower than inflation. And the third way that inflation hits the hardest is on fixed income sources. So a lot of the times you just saw it in this past market. When inflation is happening, what's normally going on? People's wages are going up and they're spending more. And while that's happening, while inflation can be rough for the average everyday American, at least they have the ability to get a new job at a higher wage in that hot economy. And that's what was happening. We're at full employment. So everybody was getting a 10 to 30% raise to go get a new job, which then caused them to spend more money in the market, which then was increasing the prices of the goods. So we know that that is a part of inflation. Well, if you're retired, you don't have the ability to just go in the market and get a 20 to 30% raise. You have a fixed income. And if we have a fixed income and inflation is outpacing our investments, we're in trouble. So inflation definitely has a huge impact on retirees more than any other class of people, because everyone else can at least go get a new job. They can at least sell their house in the hot market. They can make all the adjustments and take advantage of that economic climate. While when we're retired, we don't really feel like moving all the time. We don't feel like getting a job, even if they're going to pay us 30% higher than what our last wages were. We just didn't have any plans of working. And so those end up being the three hardest hit areas when we're talking about the impact of inflation, especially on retirees. And so normally what we'll do, and we'll go through this video where I'll give you a couple of examples. One example I'll give you is actually showing you how much $50,000 would look like if it kept up with a 3% inflation rate over 30 years, which would not be crazy. You could retire at 50 and be 80. You could retire at 60 and be 90. You can retire at 65 and be 95. The second thing I'll show you that also really shows the impact of inflation that we often overlook is within our withdrawal strategy, where we'll have a case study where we have $1 million set aside in a retirement fund and we have a 5% withdrawal strategy. And what that looks like, even if our investments are also growing by 5% each year, because that's the general idea of an effective withdrawal strategy. I withdraw 5%, my investments create 5%. As a result, that means I'm at a wash. But the impact of inflation changes the calculation of that. And I'll be able to show you mathematically through a chart what that also looks like, whether we can maintain that 30 years of $50,000 that keeps up with inflation. And what I'll do is I'll put a chart up for you, and this is called a basket of goods. And all it's doing is taking the consumer price index of a handful of items. And one of the important things about understanding inflation is inflation doesn't impact all of our goods the exact same. That yes, on average is 3%, but all items don't go up by 3%. And you can see that items like toothpaste, where it was $1.49 in 1998, which is basically about 25 years ago, that in 2021 it was $5.92. And you can see that inflation has become a really big problem for us in recent times, where when you compare the increase of prices of certain items from 1982 and 84 to 98, which was about a 15-year span, you can see that the price of milk, for example, did not change. You can see that the price of peanut butter did not change much. You see the price of a 60-watt light bulb did not change much. I think you get the idea. But you can see that as we've gone into this new unbalanced budget environment, and that's one of the reasons why I'm such a strong advocate of having a balanced budget. If we don't have a balanced budget where our money is worth less every single year, and that is increasing from the wars and the bailouts and just overall spending, that inflation is sometimes referred to as the people's tax. That if we have a balanced budget where we just stop spending in certain areas, that would upset some people. But if we just tell everybody that they can always get what they want, that we always are able to print the money, you don't have to really worry about it, as our current political system is, as a result, it's essentially us being taxed as an entire society. That if you just print the money and lower the value of my dollar, that it's as if I'm being taxed. It's as if all of us are being taxed a little bit more because I have to have more. So whatever that inflation ends up being, that's essentially a tax that the government's adding to us. Now, of course, there are multiple types of inflation, so we can't put it all in the government. There is demand pull inflation, which is basically what we went through with COVID, where just because there was such a high demand for toilet paper and hand sanitizer, it increased the price of it. You can see in Florida, where we deal with hurricanes, that the price of water and canned foods and things like that go up significantly in price as hurricanes come closer. That is because the demand is so high that there are people willing to pay even that higher price. So that is a form of inflation. You also have the cost pull inflation. So we also dealt with that with COVID, where the logistical aspect of things caused the things to be more expensive to put on the shelf. That could be something as simple as the price of lumber going up, so the price of the house built with lumber goes up. That is your cost pull inflation. We also have the wage price spiral. And all that is this idea that if I increase how much I pay you in a salary, that increases how much it costs for me as a business, which then means I increase how much my products are to sell to cover the cost of a higher employee. And then obviously you are sitting there feeling the exact same way. I got a raise, and yet I still can't afford the lifestyle. So you go back and ask for another raise, and then the employer gives it to you, but then they increase the prices again to cover the higher expenses of their labor. And we just go through that spiral that no matter what I do, I can't increase my purchasing power, which is ultimately what we all want. We just want to be able to afford our lifestyle. And the fourth form of inflation is what we've been talking about. That is just excessive printing of money. If we just print a bunch of money, then money becomes less valuable. And that's true with everything. That is why something as abundant as gold and oil, or even the food that our farmers produce, that we control the quantity of them to maintain a certain value. That there is an abundance of food that is available, especially when you look at the technological advancements, to wipe out world hunger. But many governments subsidize their farmers to not provide as much food because then the farmer can't maintain their lifestyle. That if I made food literally pennies on the dollar, well, then when the farmer sells it, how do they maintain their lifestyle? And so that is what we talk about. That is this idea of excessive money printing. If you want the dollar to be valuable, there should be less dollars available. That is what drives value. And regardless of what caused the inflation, when you look back at the chart, you can see that the price of different items go up. You can see, for example, that an automobile tune-up in 1998 was $42, and that went up to $300. That's a 700% increase. That far exceeded the impact of inflation on peanut butter, for example. You see that peanut butter just doubled in price. I mean, just doubled in price, I understand, but this went up 7 times its price. You can see toothpaste, which was $1.50 and now it's closer to $6. Well, that went up 400% from its original price. And this is not unreasonable. It's not unreasonable for someone who retired in 1998 to still be retired in 2021. And they need to make sure that their purchasing power is maintained. They still have to buy milk. They still have to buy toothpaste. They still have to buy peanut butter. Now, obviously, these individual items, you may not feel that way, but you get the idea. If I was buying these things in 1998, I still want to be able to buy these things in 2021. But you can see from inflation the impact of maintaining your exact same retirement lifestyle, you're not buying any new items, has significantly increased. Now, when you look at the impact of inflation purely from a retirement income perspective, I'm going to put a chart up, and what you'll be able to see is that $50,000 was what we needed in year one to purchase and afford all of the dreams that we had for retirement. And you can see that increasing that by 3% in year two means that you need $51,500. And then you increase that number by 3% again for year three, and now we're at $53,045. Now, I'm not going to read every number out loud, but you can see at the end of year 30 that the $50,000 that you needed to maintain your retirement lifestyle now requires $117,828.28. That you need more than double the amount of money that you had, just assuming inflation is 3%. Now, I've already shown you the impact on your consumer prices, where we've already seen that it can be much more than a 3% increase over the span of your retirement, where it isn't just that 3% each year, that some items go up significantly more than that, depending on what's going on in the overall environment. And so when you're looking at this and you're saying, okay, well, Dre is basically giving me best case scenario of inflation, which is best case scenario is about 3%. The Fed themselves, and I'll share a link to another video where I go through some of the analysis of the Fed and the chairman when they speak on their goals with inflation and unemployment. Well, their goal is to be around that 2 to 3%. And so that is $118,000 if we just assume the bare minimum. Now, you and I know that that is not always what's going to happen, which means the impact of inflation could be much more than that. And that's why it's very important that when we're focusing on inflation, that we're thinking of from two perspectives: the money that's growing and the money that I'm taking out. Now, before I go into some of the strategies to make sure that we're outpacing inflation, the last thing I wanted to discuss with you all is how it affects your withdrawal strategy. So normally what we'll do is we'll say if I have a withdrawal strategy of, let's say, 5%, and I have an investment strategy of, let's say, 5%, well, the two of those match up, which ultimately means that I should never run out of money, right? I have $1 million invested, I take out 5%, it grows by 5%. I'm basically just living off the income. But because you just saw that it does impact what your lifestyle is like, if we then take the 5% withdrawal and increase it by 3% each year, and I'll share a chart with you where you'll be able to see now all of a sudden I don't have this ability to have an infinite amount of money. In fact, if I adjust my withdrawal strategy by 3% each year, I actually run out of money in my 27th year of retirement. Now, for many people, they'll say 27 years, I'll take that, Dre. That is okay with me. Now, the issue with that is we're making certain assumptions in this calculation. The first assumption is that inflation is only 3%. The second assumption is that we are growing by 5% each year. And so when you take these two assumptions into calculation, you and I both know a couple things. We know inflation won't be 3% every year, and we know our returns won't be 5% every year. Now, hopefully inflation averages 3% and our returns average 5%. So it kind of works out the way we calculated, but it's very important to be considering inflation in your retirement plan. I don't want you sitting there saying, well, I have $1 million in my portfolio. I'm going to live off of $50,000. I have an investment strategy that's going to grow by 5%. I'm done. I have nothing to worry about, which is why when you talk about protecting your retirement savings, ensuring that inflation doesn't erode your purchasing value, which is a very fancy way of saying it doesn't decrease your lifestyle, it normally means that we have to be investing for growth. It doesn't mean we have to be risky in our investments, that we should have a strategy and a plan that gives us the highest probability of success, and then we execute that plan consistently. Normally, a great place to start is building 3 streams of income. The numbers show that 65% of self-made millionaires have at least 3 streams of income. And then when you're saying, all right, well, Dre, how do I get those 3 streams of income? We see that there's 3 asset classes that everyone invests in to gain these streams of income. And that is going to normally be the stock market, in a business, or normally in real estate. That these are normally going to be the 3 places that we invest to have access to these 3 streams of income. And then you decide which streams make the most sense for you. If you like real estate, then rental income may be an avenue for you. If you like small businesses, you can invest in businesses that have some sort of a royalty income where they may have a patent or a trademark or some proprietary process to where you're able to take advantage of that. There are a lot of ways to have access to these streams of income, but it's very important that we're focused on building at least 3 streams of income. We know that that is going to give us access to a lot of growth to ensure that we have the income that we need that is being passively generated from our investments instead of us actively working as we did when we had earned income. That's the only stream that we're normally not focused on in retirement. So if inflation is normally about 3%, and we know that on average the stock market is somewhere around 8 to 10%, now granted, we do have to adjust our investments. We can't just be all in on the stock market and the risky aspects, but we can have a strategy that works for us to ensure we outpace inflation. Now, for someone who's a little bit more risk averse, then it might be a good strategy for you to focus on having a pension of some kind, maybe invest in some TIPS, which is Treasury inflation protected securities, where we find some investments that match our risk tolerance, but we still are ensuring that we're outpacing inflation. We got to at least be generating that 3%. Now, depending on your overall withdrawal strategy, maybe it makes sense to start investigating whether some annuities make sense. And I'll put a link to a video where I go through some strategies as far as choosing an annuity and understanding some of the pros and the cons of them. But really, when you're looking at it, we want to have a integrated plan. We want to have a lot of flexibility built in our retirement plan where we have a portion of our portfolio performing well in a variety of economic climates. And once we have that, we just need to follow the plan. We need to be comfortable knowing that there's going to be a portion of our portfolio that isn't going to perform well in any given environment, but we have another portion of our portfolio that is going to perform well in any given environment. Third on the list is we need to review our plan regularly. We touched on it a little bit earlier, which is just the idea that we have assumptions built into our plan. And if those assumptions change, our plan should change. Those assumptions could be based on the economic environment, such as inflation and the growth of my portfolio. Those assumptions can be based on your own personal life, what state or country you're going to live in, whether you were married or single. It can be based on our health and life expectancy. There are a lot of things that go into consideration when making a retirement plan. And if those assumptions change, then we should be adjusting our plan as those things change. And the fourth way to protect your retirement savings is to maximize the tax efficiency. If we're someone that either isn't very comfortable investing in certain asset classes that keep up with inflation, then sometimes we're able to adjust how much we have to pay out. The same way we might be able to adjust our expenses or we pay off debt, the same way we could adjust how much we have to pay out in taxes. Where if we lower what our bill is, then I don't have to have as much income. And so many times having tax efficient strategies as a part of your overall retirement strategies, whether you're talking about what you're investing in or your overall withdrawal strategy, that can free up tens of thousands of dollars inside of many people's retirement plan. So ultimately, inflation is not something that you can avoid, but we got to prepare for it. By factoring inflation into your retirement plan, your investment strategy, regularly reviewing your overall retirement plan, and then making those adjustments, you can set yourself up for success where you can be ahead of the impact of inflation, which gives you the ability to ensure that your retirement savings last your entire retirement and the cost of something can be the furthest thing from your mind, as the numbers show that 76% of Americans worry about money. Hopefully you found this video valuable. If you did, I simply ask for you to like and subscribe so you can continue receiving valuable insights on how to create your own wealthy retirement system. Until next time, stay safe and enjoy life.